Hi everyone, good day to all of us. This is again another topic that we are going to discuss about financial accounting. Okay, so we are almost done with the coverage of our financial accounting. So this next topic that I am going to present in this video is about plant assets, natural resources, and intangibles. No, so these are long-term assets that will be presented in our balance sheet. One line item for plant assets, one line item for natural resources, and one line item for intangibles. Now we'll discuss them one by one. No, I will touch a little of intangibles later. So the definition of plant assets, this is also known as property, plant, and equipment. Okay, so in other books, the term property, plant, and equipment is used, or fixed asset are long-lived assets that are tangible. Tangible meaning you can touch it. Okay, land, buildings, and equipment are examples. The expense associated with plant assets is called depreciation. Okay, so all plant assets except land is subject to depreciation. It is the normal wear and tear of the plant assets. Of the plant assets, land is unique. Okay, land is not expensed over time because its usefulness does not decrease. In actual case scenario, land appreciates every year. It's the only item in the plant assets which increases its value over the years. Next is natural resources. These are such as oil and gas reserves, coal mines, or stand of timber are accounted for as long-term asset when they are purchased or developed. As the natural resource is extracted, its cost is transferred to inventory. Okay, so natural resources is a limited asset. Okay, so there will come a time that when you purchase land, for example, all those natural resources in that land will be exhausted. So that's why we have to deplete the value of the natural resources. The term used for plant assets is depreciation, while the term used for natural resources is depletion. Intangible assets, on the other hand, they are useful because of the special rights they carry. They have no physical form. Patents, copyrights, and trademarks are intangible assets, as is goodwill. Okay, so out of the three, the intangible asset is the only asset that you cannot touch. There is no physical form of these intangible assets. But they qualify as an asset because all the criteria for us to recognize as an asset is present in these intangible assets. First, because there is this future economic benefit that we can derive from these intangible assets. A patent, for example, patent is the legal right to use a specific invention. If you have invented something, something new, it's not yet in the market, you can patent that. That's so that you will be the sole person who can reproduce or produce those items. So that's an economic benefit, because that you can actually sell those items later on if you are able to produce it. Copyrights, on the other hand, are the legal right to copy songs or poems, movies. So actually it's illegal for us to copy movies, songs in our cell phone, in our USB, because it has copyrights. So it's a legal right, by the singer or the writer, so that he or she has the sole authority to reproduce those songs or movies. Trademarks, also, like for example, trademark is a specific sign, or mark, that identifies the item. Like for example, in Jollibee, trademark is the bee, the Jollibee. No, so you cannot actually use that in your store, no, because that is a trademark of Jollibee. No, Coca-Cola, for example, no, the way, no, that the Coca-Cola word is written, no, that's actually a trademark of Coca-Cola. Again, you cannot use that, no, in your store or in your specific product, because that is a specific trademark allowed to be used only by Coca-Cola. No, and goodwill. No, goodwill is somehow there is this um, uncertainty, no, of this intangible asset, no, because it does not really um, give us, no, we are not really certain, no, that this goodwill gives us future economic benefit, no. Okay, long-lived assets and related expense accounts. So we call all of those three as long-lived assets because they go beyond 1 year. No, their lives is more than 1 year. So first is plant assets, no, that we discussed a while ago. No, example of plant assets is land, buildings, machinery, equipment, furniture, fixtures, land improvements. Okay, so they're related expense accounts. No, if you are going to amortize, no, their value is for land. There is no expense accounts. Again, um, land is the only unique item in our plant assets because land does not depreciate. It does not decrease its value. Actually, as long as you use the land, or even if you don't use the land, it actually increases its value. Buildings, machinery, and equipment, no, fixtures, land improvement are all subject to depreciation expense. Meaning, as the year passes by or as you use the asset, no, it actually is being reduce its value, no? Or we call that the normal wear and tear of the asset, no? Like for example, building. Normally, building um, would last 20 years, no, or 30 years, no, depending on the standard used, no, for the construction of the building. Furnitures, no, like tables, chairs, cabinets, those have lives, no. It will actually be damaged after a certain number of years. And also land improvements like fences, pavements, no, those are assets which has useful life, no. And after that, no, after that useful life of that specific equipment, of course that equipment or asset cannot be used anymore. Okay, so natural resources on the other hand, like for example, you bought a land with oil reserve, or you bought a land with minerals reserve or gold reserve, no, so those mining companies that we see on TV, no, or even that we hear, those companies purchased or developed their natural resources, no, and then they extract natural resources from it in order to use those natural resources. Probably they would sell it, or they would develop, no, that minerals, no, or natural resources. So every time, no, you extract something, no, from the natural resources, you should record depletion expense, no, through cost of goods sold. No, depending on the matter, if you are selling, no, the items, then that would go to cost of goods sold. Intangible assets, on the other hand, no, we will expense these intangible assets through amortization expense. Now, of course, there are also limits. No, like for example, patent. No, there is this life of the patent. I'm not just certain of the number of years, no, but there is certainly a limit. Even in copyrights, no, just like for a song, no, if the singer would die, no, of course there is this number of years also wherein after that certain number of years the copyright would be of no use, no, meaning anybody can already copy the song. Okay, so Okay, so those are the long-lived assets. So accounting for the cost of plant assets, no? So if we account, no, for these plant assets, no, how do we record it? Let's say, for example, land. Okay, so you cannot actually create land. You can only purchase land. That's why there's only one way, no, of acquiring land is to purchase. Okay, so we have or you received it through donation, no, but you cannot create land. So these are the items that are part of the cost of the land, no. It's not just purchase price, no. So there are various costs, no, which should be part of the cost of the land, no. So brokerage commission, that is included when you pay a broker, no, for their fee, no. Survey fees, legal fees, back property taxes. Okay, back property taxes, these are unpaid real property taxes. When you purchase the land, you cannot actually transfer it to your name if there are unpaid real property taxes. By the way, real property taxes are paid annually, no? That is actually being computed, no, by the local government unit concerned, no, through the assessor's office and the treasurer's office. So every year you should pay your property taxes. If in the event that you purchase a land wherein the property taxes is not yet paid for a certain number of years, you cannot transfer it under your name until you are able to pay back property taxes, no, and that should be part of the cost of the land. But the subsequent property taxes should be expense and not part of the cost of the land. Then cost of grading, clearing, and removing unwanted buildings. Okay, so if you bought land and there are unwanted structures, no, structures that is not necessary, no, for you to use the land and you need to remove it, then the cost of those grading, clearing, and removing of unwanted buildings should be charged to the cost of the land. Okay, take note of this. No, the cost of the land does not include the cost of fencing, paving, security systems, and lighting. These are separate plant assets called land improvements, and they are subject to depreciation. Okay, so those items, no, attached to the land, no, but is subject to depreciation, should not be part of the cost of the land. No? Fence is attached to the land, but fence will not take long. No? Normally, fence would last, depending on the quality of the fence, 5 years, 10 years. Paving, security systems, no, CCTV, lighting, so those are separate plant assets. So you record it not as part of the land, no, because you cannot depreciate land, but for other plant assets. Okay, so let us have here an example. Suppose Fedex signs a $300,000 note payable to purchase 20 acres of land for a new shipping site. Fedex also pays $10,000 for real estate commission, $8,000 of back property taxes, $5,000 for removal of an old building, $1,000 survey fee, and $260,000 to pave the parking lot, all in cash. Okay, so question here is, what is Fedex cost of this land? Okay, so how should Fedex, or how much should be recorded as cost of the land? So the answer is $324,000. Okay, so take note that we only included, aside from purchase price, we included real estate commission, back property taxes, removal of the building, and survey fee. What is the item that is not included here? It's the $260,000 to pave the parking lot. Okay, again, if you made an improvement in the land, no, which is subject to depreciation, that should be recorded under land improvements and not part of the cost of the land. Okay, so our journal entry would be debit land, credit note payable, and credit cash. Okay, so next. Okay, accounting for the cost of plant assets. No, so if you are you had your building, no? Actually, there are two ways in order to um, acquire a building. No, you can construct it. No, if it is constructed, these are the items, no, that should be capitalized as cost of the building. Okay, so I will not explain them one by one, but those are the items, no, that should be capitalized as cost of the building. But if the building is purchased, these are also the items, no, that should be included in the cost of the building. Okay, brokerage commission, still, no, in the building, no, there is still brokerage commission, taxes, these are real property taxes, and cost to renovate. Okay, so if you notice, no, if you purchase a building, of course there are um, the number of items is relatively small than constructed, no, because the building is ready made, no, and you just purchase it, no. Usually in construction, no, the costs are so comprehensive, no, because there are various type of expense, no, even sometimes it's not listed here, no, in my presentation, but it's actually part of the cost of the building. Okay, so machinery and equipment on the other hand, no, these are the items that should be included in the cost. Okay, so we have here purchase price, transportation cost, insurance, taxes, purchase commission, installation cost, and any expenditures to test the asset before it's placed in service. Okay, for example, you purchased, typical example of machinery and equipment is computer or laptop. If you purchase it somewhere in Cagayan de Oro and you are here in Manolo Fortich, of course you had paid the purchase price, and if the transportation cost from Cagayan de Oro to Manolo, that should be included, no, as part of the cost of the computer. Insurance, no, taxes, no, you have value added tax that should be included in the cost. Purchase commission, if there are any. Installation cost, okay, if there are expenses, no, when you purchase the computer and there are still installation costs, no, like for example you paid a mechanic, no, or a computer what do you call that, somebody who installs computer, no, like you don't know how to connect the wires, no, because there are certain components units in computer. You have CPU, monitor, UPS, no, and if you paid somebody to install those, that is part of the cost. And any expenditure, yeah, another example, if you still purchase the operating system, no, because the computer you purchase does not have an operating system, or installed software like Microsoft Office, no, those are part of the cost of the computer. And any expenditures to test the asset before it's placed in service. Okay. How do we treat, no, lump sum or basket prices, no? This is common to land and buildings. We have here, suppose Fedex purchased land and a building in Denver. The building sits on 2 acres of land, and the combined purchase price of land and building is $2.8 million. An appraisal indicate that the land's market value is $300,000 and the building's market value is $2.7 million. Okay, so this is very common. No, you cannot actually purchase the building only, because you cannot carry the building, no, only, and where would you put the building? So usually when you buy building, it is actually included in a basket price together with the land, no. So in this example, no, the appraisal indicates that the land's market value is 300,000 and the building's market value is 2.7 million, meaning if you combine this, that should be 3 million, no, but your purchase price is only 2.8 million. So as I've said a while ago, land does not depreciate while the building depreciates. Therefore, in recording for the transactions involving this basket price, you have to separate the cost of the land and the cost of the building. But how would you allocate the 2.8 million purchase price? How much should be recorded as land and how much should be recorded as building? So in this example, no, we will compute for the allocated basket price, no, of each asset. So how do we compute that? First, we have to compute the total market value of land and building. So land, 300,000 and the building is 2.7 million. So the total market value is 3 million. So the percentage of those items relative to its total market value, for land, it's 10% and the building is 90%. Meaning, if you have a total of 3 million, 10% of that goes to the land and 90% goes to building. Then these percentages should be multiplied to the basket price. Okay, so in this example, our basket price is 2.8 million. So 2.8 million times 10%, you get 280. 2.8 million times 90%, you get 2,520,000. All in all, it's 2.8 million. So our accounting entry to record the acquisition of land and building is as follows. You will debit land, $280. You will debit building, $2,520. And you will credit cash, 2.8 million. Okay? So again, you need to record separately land from building because land does not depreciate and the building is depreciated over its useful life. No? It may happen that the building will be depreciated already but the land is still usable in its full potential. Okay, so how do we know if the expenditure is a capital expenditure or an outright expense? No, like for example, this is applicable to improvements, no, in the building. Like for example, you have a building and you have renovated or repaired the building. So should that be treated as capital expenditure or an outright expense? No? So the answer is, if it increases an asset's capacity or extend its useful life, it is a capital expenditure. It is an outright expense if it just maintain the asset or restore it to working order. So, like for example, you have a building and you renovated the building such that you increased its capacity. No? Like for example, you have initially your building is or has a capacity of 50 persons. And you renovated it and it became 60 persons, meaning the asset has increased its capacity, then that is a capital expenditure. But if you just maintain the asset, no, or restore it to its working order, like for example in your building, you just repair the doorknob, or you just replace the bulb, or you just fix the windows, no, to restore it to working order, then that is outright expense. That should be recorded as a repairs and maintenance expense. Capital expenditure, it is usually material, and if it is an expense, it is usually immaterial. So, meaning the amount is, when can we say that the amount is material? We can say that the amount is material if that amount will affect, no, the decision of the users of our financial statements. So the discussion of materiality would depend upon the judgment of the company, no, or the business or the accountant of the business. No, whether in his judgment the amount is material and the amount is immaterial. There is no fixed or specific amount, no, that we can say that the amount is material or immaterial. Again, that should be left upon the judgment of the company, or depending if the company has policy, then that should be followed. Okay, depreciation, no. Again, so what is depreciation? This is the wear and tear, no, of a specific equipment or asset or plant asset. So these plant assets wear out, grow obsolete, and lose value over time. To account for this process, we allocate a plant assets cost to expense over its life, a process called depreciation. Okay, so depreciation is only applicable to plant assets that are depreciable. No, again, the land is not subject to depreciation. So depreciation apportions the cost of a fixed asset over time by allocating a portion of that cost against the revenue that the asset helps to earn in each period. Okay, so our property, plant, and equipment, for example, a building, generates revenue over time. No, especially if we are in the business. For example, your business, you have a store and you have a building. Of course, the building helps you to sell. No, therefore, every time you sell, no, you should actually match expenses in your selling. No, aside from the cost of goods being sold, there are these depreciation expenses or fixed expenses that you should also report. That's why every year or every reporting period, you should record depreciation in order to match revenue with expenses for that particular year. So when we talk about depreciation, we should be able to be familiar of these three terms. First is the cost. Okay, second is estimated useful life, and third is estimated residual value. Okay, cost, we already have discussed cost a while ago, no, in our discussion. What are parts of the cost? No, land, building, machinery. No, we have discussed what are the components of this cost. Okay, estimated useful life is the length of service expected from using the asset, which can be expressed in years, units of output, miles, or some other measure. Okay, so it is estimated, no, estimated useful life. By the way, class, no, when you depreciate, actually you cannot really say that that is the exact amount of reduction of value of that asset, no, because in the first place you only estimated this, no. Like for example, a computer, in the first place you do not know how many years would that computer last in your business. All you need to do is to just estimate, no, that the computer would last for a certain number of years based on your experience. Or units of output, no, like for example, photocopying machine, no, there are photocopying machines which specifies the number of units of output that it can produce, no, and the life would end, no, of the photocopier. There are equipment like that, no, or miles. Okay, miles in case of a vehicle, no. Sometimes the life of the vehicle would depend upon the number of miles traveled, or some other measure, no. And estimated residual value, this is also called scrap value or salvage value. This is the expected cash value of an asset at the end of its useful life. Okay, so most asset will have its value at the end of its useful life. It's not usable anymore for the company, but it still has value. No, the least that it can have its value is when you sell it at a junk shop. No, like for example, a computer, you sell it at a junk shop. No, you will actually derive some value from it. No, but there are also assets, no, which is usable to other parties, even if it's already fully depreciated on the part of the company, no. So that is estimated residual life. No, cost here is the only figure that is exact, no, because that is the actual amount when you purchased or constructed the asset. No, this is the actual amount. But the two values here, the estimated useful life and the estimated residual value, are not exact. It's just estimated. Okay, so we have here depreciation methods. First is straight line method, no, meaning you will just use number of years. Units of production method will only will use the number of units of production, and double declining balance method. No, we will discuss them one by one. So we have here straight line method. So with the straight line method, an equal amount of depreciation is assigned each year or period of asset use. The depreciable cost is divided by the asset's useful life in years to to determine the annual depreciation expense. So let's have this example. We have here the cost of the truck, $41,000. We have here residual value. No? Again, residual value is the estimated value of the asset at the end of its useful life, so $1,000. So we have here the depreciable cost of $40,000. Meaning this is the amount that you will apportion, no, for the rest of the life of the asset. So we have here number of years for if we use number of years, or unit of production. If we use units of production, 100,000 units or miles. Okay, so for straight line depreciation, this is the formula. Okay, remember this formula. Straight line depreciation per year equals to cost minus residual value over useful life in years. So that is the formula for the depreciation of an asset under straight line method. So in this case, our cost is $41,000. No, and our residual value is $1,000, estimated residual value, and our estimated useful life in years, 5 years. So we have here 8,000 as our yearly depreciation. Okay, so for straight line depreciation class, this method ignores the usability of the item every year. Like for example, in that particular year, you did not use the asset, but still you have to depreciate it. Whether you use it or not, you have to depreciate it. That's straight line method, because every year you have to produce, you have to record a specific amount of depreciation. So our journal entry for depreciation is debit depreciation expense, truck, and credit accumulated depreciation, truck. Okay, so 8,000 pesos. That is the result of our computation a while ago. Depreciation expenses class is an expense, and that will be reported in your income statement. And accumulated depreciation is a contra asset account. Meaning if you will report now in your financial statement the value of the truck, this amount, 8,000 pesos accumulated depreciation, would be deducted from the cost of the truck in order to arrive at its net book value. Okay, so this is the depreciation table for this particular example. For the truck, its cost is 41,000. So that is the book value at the beginning of its life. So we have here the depreciable cost of 40,000 after deducting the estimated residual value. And our depreciation rate is 20%. So how did we get 20%? That's actually 1 divided by 5 years. Okay, so each year you will depreciate 20% of your depreciable cost, which is computed earlier at 8,000. So your yearly expense, depreciation expense that should be recorded in your income statement is 8,000. And we have here accumulated depreciation. Accumulated depreciation is a contra asset account. Therefore, every year it would increase its value. So in your presentation of your financial statements, your book value minus accumulated depreciation is your net book value. So on the first year, after the first year of the usage of the item, your book value is 33,000. That's 41,000 minus 8,000. 33,000. On the second year, you will again record 8,000 depreciation, meaning your accumulated depreciation now becomes 16,000. So 41,000 minus 16,000 equals 25,000. On the third year, you will again record depreciation of 8,000. So your accumulated depreciation becomes 24,000 now. So 41,000 minus 24,000, that's 17,000 book value. Okay, on the fourth year, you will again record 8,000 depreciation. So your accumulated depreciation now will be 32,000. So 41,000 minus 32,000, your book value is 9,000. And lastly, on the last year of the life of the equipment, you will record again 8,000 as depreciation. So your accumulated depreciation now is 40,000. So 41,000 minus 40,000 equals 1,000. Notice, class, that on the end, no, of the life of the asset, no, at the end of the life of the asset, the remaining book value of the asset should be equal to its estimated residual value. In this case, the residual value is $1,000. Okay, but there are also companies which does not provide for residual value. Just divide the cost, no, through its estimated useful life, no. But it's again, it's a matter of company policy. It would depend upon the company if they would recognize residual value for specific asset. Units of production method, no. This is a depreciation method which uses a fixed amount of depreciation to each unit of output or units of service produced by the asset. The depreciable cost is divided by the asset's useful life in units of production to determine this amount. The per unit depreciation expense is then multiplied by the number of units produced each period to compute the depreciation. So in this case, we'll use again the same example. We have the truck. Cost of the truck is $41,000. We have our estimated residual value of $1,000, and our depreciable cost is at $40,000. So we will use now units of production. In this case, our units of production is 100,000 miles, meaning we estimate that the truck can travel for 100,000 miles. Then after that, that's the end of its useful its life. No. Okay, so this is the formula. It's more it's almost the same as straight line method, but the denominator is different, no? So we have here units of production depreciation per unit of output equals the cost, no? 41,000 residual minus residual value 1,000 divided by the useful life in units of production. So in this case, our figures would be 41,000 minus 1,000, so that's 40,000 all over 100,000 miles. So the resulting figure is 40 cents per mile, or $0.4 per mile. Okay, this means that every mile traveled by the truck, you should assign depreciation of $0.40. Okay, so this depreciation method gives us an idea, no, that the company uses, no, the miles traveled, no, by the truck in order to compute for depreciation. Probably this is the real way to compute the depreciation in case of a truck. Okay, so again, no, what should be used is straight line or units of production. It depends on the company policy, and it depends on the owners of the business. So our journal entry assume that Fedex expects to drive the truck 20,000 miles during the first year, 30,000 during the second year, 25,000 during the third year, and 15,000 during the fourth year, and 10,000 during the fifth year. Okay, so so the depreciation now would depend upon the number of miles traveled. No, unlike straight line depreciation that just uses number of years, no, and you do not put into account the miles traveled by the truck. So this method, units of production method, considers, no, the output being produced by the asset. So the journal entry to record the depreciation in the first year is you debit depreciation expense truck and accumulated depreciation truck. Okay, so we have here a coincidence, no, that the straight line method and units of production method produces the same result, no. So actually the way of computing, no, in this example is that on the first year, no, we have 20,000 miles. Second year is 30,000 miles. Third year is 25,000. Fourth year is 15,000. And fifth year is 10,000. You just multiply these figures by the rate per unit. So we have computed it a while ago that each mile traveled by the truck you will assign $0.4 as depreciation. Okay, so 0.4 multiplied by the number of units. These are the yearly expense. No, so again, no, we have computed 8,000 for the first year, and it's a coincidence, no, that our amount is the same with straight line method. Okay, so these are the figures. So our accumulated depreciation now would depend, no, on the number of the depreciation. So we have here 40 on the first year 41,000 book value, and we have recognized depreciation of 8,000. So accumulated depreciation is 8,000. Our book value is 33,000. Okay, so on the second year, you have recorded, for the same entry, you have recorded depreciation expenses of 12,000. So your accumulated depreciation now becomes 20,000. So your book value is 21,000. That's 41 minus 20. On the third year, you recorded depreciation expense of 10,000, and your accumulated depreciation becomes 30,000. So 41 minus 30, that's 11,000. On the fourth year, you record depreciation expense of 6,000. So your accumulated depreciation now becomes 36,000. So your book value is 41 minus 36, 5. And on the last year, you recorded depreciation expense of 4,000. So your accumulated depreciation now is 40,000. So 41,000 minus 40,000 equals 1,000. Again, take note that at the end of the useful life of the equipment, after depreciating the equipment, the remaining amount should be the estimated residual value. Okay, double declining balance method is another method of computing for depreciation. Now, this is an accelerated depreciation method because it writes off a larger amount of an asset's cost in the early years of its useful life. The method computes annual depreciation by multiplying the asset's declining book value at the beginning of the year by the constant percentage that is 2 times the straight line depreciation rate. Okay, so we have here an example again. So we are using actually the same example. So double declining balance depreciation rate per year. So we'll use this formula 1 over useful life in years times 2. No? So we are actually using 2 times, no, the rate of the straight line method. So a straight line method is 1 over 5 years, 20%. You multiply that by 2, you get 40%. Okay, meaning on the first year of the life of the asset, we will multiply 40%. And on the second year of the life of the asset, we will multiply 40% by the remaining book value. Okay, let us have here the depreciation table. Okay, so this is our first entry on first year, depreciation of first year. So how do we compute that? So this is our depreciation tables. We have here the cost of 41,000, no, or the book value at the beginning of the year. You multiply it to the double declining balance rate. So we have computed a while ago at 40%. So 41,000 times 40% is at 16,400. Okay, so that is also the accumulated depreciation. So 41,000 minus 16,400 is the remaining book value now is 24,600. On the second year, you will now multiply this remaining book value. Okay, take note of this. You will use this remaining book value, 24,600 times 40%. Okay, so 24,600 times 40% equals 9,840. Okay, so you add that to your accumulated depreciation. So that's 26,240. So your book value now will be 41,000 minus 26,240 is 14,760. Notice that on the second year, the book value of the asset is relatively small already, no? So you already have depreciated more than half, no, of its useful life. So on the third year, 14,760 is the book value. You multiply that again by 40%. So the resulting figure is 5,904. So you add that to the accumulated depreciation, it becomes 32,144. So the book value is 41,000 minus 32,144 equals 8,856. Okay, on the fourth year, use this value. The remaining book value is 8,856. You multiply that by 40% and you'll get 3,542. You add that to the accumulated depreciation, so it becomes 35,686. So the book value now is 41,000. Okay? So the book value is 41,000 minus 35,686 equals 5,314. And on the last year, okay, take note of this. This is different computation on the last year, because you will now depreciate what is left in the depreciable amount. Okay, so remember that our depreciable amount is 40,000. No, so what is left is 4,314 in order to complete the depreciation of 40,000 in that particular asset. No? So this is only true, no, for this is true for other depreciation methods, that on the last year should be the asset should be depreciated on its remaining depreciable amount. No, in order for us to arrive at the accumulated depreciation of exactly 40,000 and our net residual value of 1,000 at the end of the year. Okay, so notice in this double declining balance, no, that there is this significant differences, no, in the yearly depreciation expense. Okay, this is applicable to assets which is decreases its usefulness over the years. No, there are assets like that wherein on the first year you are actually getting the most of its usefulness, no, on the first year, and on the second year it is decreasing, third year, and so on. No? So on the first year we have the biggest amount of depreciation. Okay, so this is double declining method, no? Okay, depreciation for partial years. Okay, so in our real case scenario, no, we are actually purchasing the plant assets not at the beginning of the year, no, unlike in our example, we purchase it at the beginning of the year or at the end of the year, no, but in reality, no, we cannot really buy equipment at the beginning of the year, no, because that's a new year, that's a holiday, you know, and Filipinos spend most of their time at home, no, on a holiday. So normally, no, plant assets, no, machineries, furnitures are purchased at the middle of the year, no, or even on the second month or the third month or fourth month. So how do we treat for depreciation for partial years? Okay, so let's have this example. Suppose Fedex purchases a warehouse building on September 1 for $500,000. Okay, the building's estimated life is 20 years and its estimated residual value is $80,000. Fedex accounting year ends on December 31. Let's consider how Fedex computes the assets depreciation for September through December. Okay, so if the company uses straight line method, we compute annual depreciation to be 21,000. So how do we get that? The cost, 500,000 minus 80,000 residual value or estimated residual value, you divide that by 20 years. So you'll get 21,000 as annual depreciation. Okay, take note of this. This is yearly depreciation. Okay, so on the first year, since we purchased the building on September 1, there is a rule in accounting that you only depreciate an asset when it is already available for use. Okay, you do not depreciate it from January, no, because it is only available for you starting September 1. Okay, so September 1 up to December 31, that is actually 4 months. So September, October, November, December. So that's 4 months of the year. So you will compute for the depreciation for 4 months only. Okay, not the 1 year. Okay, so 21,000 is our annual. So you multiply that by 4 over 12 in order for us to compute the depreciation for the first year. So in this case, it is $7,000. Okay? So $7,000 is the depreciation on the first year. No? On the second year, no, the depreciation would now be 21,000, the full year depreciation, because the asset has been used from January to December. Okay, fully depreciated asset is an asset that has reached the end of its useful life. Okay, so most assets will reach the end of its useful life. Okay, suppose Fedex has fully depreciated some equipment with zero residual value. The equipment's cost was 60,000 and its related accumulated depreciation is also 6,000. So we'll have an idea here, class, no, that in this case, the company does not consider its residual value. No, in their computation in depreciation, they have zero residual value. So as of this point, if the asset has been fully depreciated, meaning its cost was equal to its accumulated depreciation, no? Cost is 60,000, accumulated depreciation is 60,000, meaning it has zero book value. So assuming that this asset is junk, the entry to record its disposal is as follows. So if the asset is disposed, no, you will just reverse, no, the accounts. You will debit accumulated depreciation and credit machinery. Okay, and recognize it from the books. Okay, you turn its balance into zero because it is already fully depreciated. Okay, there are times also that the asset has a residual value. Now, if you are able to account for its residual value. So let's say, for example, Fedex has a cost of the equipment 60,000 and the assets accumulated depreciation is 50,000 pesos. Okay? So naa pa siya book value na $10,000. Okay? So that's cost minus accumulated depreciation. Junking this equipment results in a loss equal to the book value of the asset. So since there is still a book value of the asset and you junk the asset, of course, the loss will be equal to its book value. So our entry in the disposal of the asset is we will debit accumulated depreciation, machinery, 50,000. We will debit loss on disposal of equipment, 10,000, and credit machinery. Since you dispose the asset without proceeds, of course, 10,000 is a loss. Okay, there are also times wherein the fully depreciated asset is being sold, no, sold by the company, no. So let's say, for example, no, the Fedex disposes an equipment that costs 60,000 by selling it for $5,000. The assets accumulated depreciation is 50,000 and the book value is therefore 10,000. So if you sell an equipment with a book value of 10,000, you sell it for 5,000, of course, you will recognize loss of 5,000 pesos. No? Because it has a book value of 10, then you sell it just for 5, meaning there is a loss of 5,000. So our journal entry for this is we will debit cash. We will debit accumulated depreciation machinery to close accumulated depreciation. We will debit loss on sale of equipment, 5,000, and we will credit machinery. Okay? So this is our entry. Okay, if the selling price is higher, no, than the book value, so suppose Fedex disposes of equipment that costs 60,000 by selling it for $15,000, this assets accumulated depreciation is 50 and the book value is therefore $10,000. So an item with a book value of 10,000 is being sold for 15,000, meaning there is a gain amounting to 5,000 pesos. So our entry to record it in the books is we will debit cash $15,000. we will debit accumulated depreciation machinery of 50,000. We will credit machinery of 60,000, and we will credit gain on sale of equipment of $5,000. Okay, so this is how you treat the disposal of a fully depreciated asset. Now let's move to accounting for natural resources. No, this is just a short computation discussion. So natural resources are long-term assets of a special type, such as iron, ore, petroleum, oil, and timber. These resources are often called wasting assets, no, because in contrast to property and equipment, they are actually physically used up over time, no. The process by which this occurs is called depletion. So actually the term depreciation and depletion is synonymous, no. It just differs in the applicability, no, because depreciation is applicable only to plant assets, while depletion is applicable to natural resources. So these natural resources are also called wasting assets. Okay, for example, suppose ExxonMobil buys an oil reserve that costs $100 million. Okay, so this is an oil company. They bought a land probably with oil reserves of estimated 10 million barrels of oil. Now, of course, that is being estimated by the company because that is somehow the basis of the company whether to buy that oil reserve or not, no, or that's their basis of the price, no, of the natural resource. So ExxonMobil is an integrated oil company, meaning it both drills for oil and refines it. So the company retains some inventory rather than selling all it produces. So it's similar to oil companies which drills their own oil and refines it and sells it. When it purchases the oil reserve, no, assuming the company paid cash, ExxonMobil makes the following entry. So we will debit oil reserve of $100 million and we will credit cash $100 million. Now, oil reserve here is a natural resource, no, that is reported as asset in your statement of financial position or the balance sheet. So the depletion rate is 10,000 per barrel. No, that's the cost 100 million, you divide that by 10 million barrels. No, so depletion is actually similar to units of production method, no? So in this case, if the depletion rate is $10 per barrel, and if on the first year, no, 3 million barrels are extracted, okay? So it should be depleted by $30 million. So how do we compute that? That's the 3 million barrels times the depletion rate of $10 per barrel. Okay? So, and 30,000 is now transferred to inventory. So, our depletion entry is we'll debit oil inventory, that's the value of the oil being extracted, and credit oil reserve of $30 million. Okay, so that is our entry. And this oil inventory will be processed, no, by the company because in the problem, it states that this the company refines the oil and sells it afterwards. Okay? So intangible assets. Okay, so these intangible assets are long-lived assets with no physical form. Examples are as follows. We have patents, copyrights, trademarks, franchises, and goodwill. Okay, so these are assets, no, which does not have physical form. You cannot touch it. No, you can only know that you have the right to use it. No, and you derive benefit from it. So again, so if you have cost, no, of course, like for example, patents, the cost of filing patents, no, there is this cost, therefore you have to capitalize that cost and amortize it over the useful life. So if patents, for example, you spend 100,000 to patent a specific invention, so that patent, 100,000, will be amortized over its useful life. Okay, so depending on the life, no, I'm not really sure, no, of the life of the patent. No, I think it depends on the authority who grants the patent. Okay, so you divide that by the useful life and you record amortization expense each year. Okay. Okay, this is the end of my presentation about plant assets, intangibles, no, and natural resources. Thank you very much for watching this video. Take care, stay safe, and God bless us all.